So with property prices and investor loans hitting their highest levels ever, Australia's banking regulator APRA is introducing new restrictions on high-risk lending. So from February the 1st, 20% of new mortgages issued by banks are allowed to have debt-to-income ratios of more than 6 times. Now let's simplify that a bit. Let's say your household earns $100,000 a year and you want to borrow more than $600,000 as either an investor or owner-occupier. Only a fifth of the new loans issued by your bank are allowed to exceed that threshold. As for how effective that'll be, one prominent banking analyst says it's like banning blokes who are 8 feet tall from going into restaurants. A lot of those around, as you know. Now, going back in time to 2014, APRA introduced an investor mortgage limit, which allowed banks to grow their number of investor loans by 10% each year, and house prices continued to rise. In 2017, it imposed a new rule saying only 30% of new residential loans could be interest only. Now, that led to house prices falling quite a bit before APRA decided to wind back those restrictions. Then COVID happened, interest rates were cut to zero, and house prices have never been higher. And in case you're wondering, the average Australian household's debt levels are about 180% greater than their incomes, which is far higher than most other countries. Meanwhile, the Australian share market has finished trading pretty much flat as tech-related stocks did well, though that was offset by big falls in stocks like QBE and Harvey Norman. Now, overseas markets did a lot better as their tech and AI stocks continued to rebound. Gold, oil and iron ore prices were a little bit higher, and the Aussie dollar is buying just under 65.5 US cents. And that's finance.